Thank you very much for that kind introduction. Chairwoman Velasquez, Ranking Member Chabot, and members of the committee. I am pleased to appear on behalf of the Board of Governors to discuss the availability of credit to small businesses. Small businesses play a critical role in the U.S. economy, and access to credit is essential for their success. As you know, the Board is required to report to the Congress every 5 years on the status of small business access to credit, and our most recent report was submitted on October 26th. While I cannot discuss all of the topics covered in our report, I would like to mention a few highlights. I will then briefly address how the unusual stresses imposed on credit markets in recent months may affect small businesses. So let me turn to the highlights of the 2007 report to Congress. Our 2007 report indicates that since our last report in 2002, financing flows to small firms generally increased along with economic activity. Credit conditions during the period were favorable for small firms, and we have no evidence that creditworthy borrowers faced any substantial constraint on their access to credit. Although small businesses obtain credit from a wide range of sources, commercial banks are today, as in the past, the leading provider. Our report shows that among small businesses, relatively large firms and relatively older firms were more likely than smaller or younger firms to use a wide range of types of credit, and more likely to have their credit applications approved. These results are consistent with the conventional view that smaller and younger firms are riskier, have shorter credit histories, or less collateral to pledge as security, and are generally harder for lenders to evaluate because they are less transparent. As was true in 2002, the 2007 report emphasizes the importance to small businesses of geographic proximity to their sources of credit. The importance of local providers of credit to small businesses underscores the need to preserve competitive banking markets at the local level. Despite the significant consolidation that has occurred in the banking industry, competitive conditions in the nation's local banking markets have remained quite stable. The use of credit scoring in assessing small business credit applications has become common only since the mid-1990s. Evidence suggests that the use of credit scoring increases credit availability to some small businesses. Users of credit scoring models generally report that after their adoption, the riskiness of the small business portfolio either remains about the same or declines, and the quality of the typical credit decision increases. The obstacles to securitizing most loans to small businesses remain large. The securitization of small business loans has remained modest and is unlikely to increase substantially over the foreseeable future. So let me turn to small business finances and recent financial market developments. Let me now comment briefly on the possible effects of the recent financial market turmoil on small business access to credit. I emphasize that the possible effects are complex, that we do not yet have much hard evidence, and that it's far too early to draw any strong conclusions. That being said, there are good reasons to believe and some evidence to suggest that the recent financial market disruptions have not seriously harmed access to credit by small businesses. And if the disruptions continue to be resolved in an orderly manner, will be unlikely to do so in the future. For example, the current turmoil has centered on securities backed by non-conforming residential real estate loans and loans or other debts of relatively large firms. Because the securitization of small business loans is still quite modest, we would not expect turmoil in the markets for securitized assets to have a large direct effect on small business lending. Recent events have nonetheless almost surely had some negative effects on small business access to credit, and we cannot rule out further effects. For example, recent surveys have found that the market for small business credit has tightened. These surveys also suggest that, at least for now, the effects have generally been quite limited. Perhaps one of the most important concerns for small business access to credit is that many small businesses use real estate assets as collateral. Looking forward, a reduction in the value of their real estate assets has the potential to adversely affect the ability of those small businesses to borrow. Similarly, declines in the value of real estate assets held by banks and other lenders may affect their ability to supply loans, as real estate losses use up capital that could otherwise be used for making new loans. Fortunately, the vast majority of U.S. banks are well capitalized and thus should be able to maintain their lending capacity. Still, the possibility remains that reductions in real estate values and other factors could affect small business access to credit. The Board will be monitoring the economy for signs of possible effects over the next few months. So let me conclude. In conclusion, the health of the U.S. economy depends importantly on the vitality of the small business sector. Our 2007 report indicates that since our 2002 report, small business access to credit has been robust. Credit conditions have no doubt tightened since mid-August, but small businesses seem generally to have been able to retain access to credit. However, the current level of uncertainty is unusually high. Thus, the Federal Reserve will continue to monitor closely the effects of financial market conditions on small business finances as part of our efforts to ensure that distress in foreign financial markets does not spill over into the broader economy. Thank you. I'd be happy to answer any questions you may have.